Hey everybody, welcome to this free edition of our Trading Group Weekly Roundup for the trading week ending May 10th, 2024. I'm Preston Britton. Thanks for tuning in. Well, this week's theme is risk on or risk off. Well, I'll get into that in just 1 minute, but let's just kind of take a look at where we've been this past week. It's a very interesting trading week. If you take a look at it, you can see everybody was in the green in the U.S. With the Dow leading the way. Everybody year to date is in the green, including the Russell, which has been bringing up the rear. But look down there for sector performance. Utilities leading the way 2 weeks in a row. Annual U.S. sector performance. Utilities leading the way for the year. Folks, that indicates a risk off market, yet markets are coming near all-time highs. Okay, really interesting market. If you look at the worst performer for the week, it was still discretionary at 11 basis points to the upside, but a strong week. Trailing PE ratio 23.24, a lot higher than I think it should be. The forward PE ratio, although it's lower by over 11%, it's still relatively high. Okay, and the current VIX, well, it closed out the week at 12.55, which is, we haven't seen these lows in quite some time. We did touch it in March of this year, but I'll show you the charts in a minute. But all in all, very slow, calm week. Okay, although the markets continue to moving up. Keep in mind the S&P is, about 1% or so off its all-time high. It's the third consecutive week in a row for gains in the S&P. We did get jobless claims. They surged way above expectations, posting their highest weekly number since August of 23. And consumer sentiment also plunged this past week, well below expectations. It hit its lowest level since November of 23. Okay. And we did see all of these things are showing that the economy is slowing down just a little bit. Okay. Although, as I said, equity investors didn't really care, pushing the S&P up for the week, as you can see, almost 1.85% for the week. Okay. Now, utilities, again, you can see over 4% for the week. We also saw strength in consumer staples and healthcare. These are two other defensive sectors outperforming the broader market. Gold was up a little over 2.7% for the week. All of these things, the April jobs report added a bit of hope to the possibility of a rate cut this summer versus this fall, although the expectation for the first rate cut is really still the higher probability September of this year. And we did see equity and bond markets kind of embracing this labor market weakness. All right, stocks rose a good bit for the week. Okay, and 10-year Treasury bonds came in right around 4.5% for the week. Okay, keep in mind, even though we're at 4.5%, historically, over the past 10 years, the 10-year interest rates averaged 2.36%. But over the past 60 years, the 10-year rate has averaged 5.93%. So remember, the markets get used to accommodation for rates. That's why, as the rates are a little bit higher now over a 10-year historical average, we're seeing different things happening. And because we're coming out of COVID, I still think there's going to be some more strange activity occurring because of COVID. All right, you can see year to date, the real estate sector is bringing up the rear with rates, still staying higher for longer over that 10-year statistical average. Now, if we come over and we look at the UK and we look across the pond, you can see everybody was in the green, solidly so. In fact, the UK, over in the UK, the Bank of England, they didn't cut their rates. They held them steady at 5.25%. But they said they could start cutting as early as June, just like the ECB. Whereas the Feds, the rate cut is possibly not out till September. And the UK also added to their economic forecast, expecting inflation to slow more sharply next year and the year after. So we'll see how all of that shakes out. But you can see year to date, Euro stocks, the 50 largest company in Europe, up 12.43%. FTSE's up strong for the year. CAC 40 up, DAX, they're all up strong. DAX had a very strong week for the week, right? So, all in all, Europe looks like it's kind of catching up to the U.S. because they've been underperforming for the past couple of years with the high inflation rates that they've been seeing. Then, of course, if we look over in the Asian markets, you can see the Nikkei almost flat for the week, but still up 14.32% for the year. So it's leading the way for the world's top 7 economies across the planet. We did see the yen depreciating to a 1.7 range against the U.S. dollar from 153, 157 to 153. So it's moved down just a little bit, and we're getting a lot of investors believing that Japan is going to come in and try and buy the yen and sell the dollar. Although there's speculation that they've done that several times over the past couple of weeks, but it really hadn't kept the yen down that much. There are some signs of weakness in the Japanese economy, which may delay some of the Bank of Japan's rate hike plans. That's what they're trying to do. We did see their adjusted wages fall 2.5% in March from a year earlier. That was worse than the previous month's drop of 1.8%. So we'll see how that shakes out. Meanwhile, in China, you can see China was up 1.6% for the week, up 6% for the year. Hang Seng up strong weekly and year to date. We did see some buoyant holiday spending across China over this past Labor Day holiday versus last year, and the S&P Global Services activity in China came in at 52.5. Now that was down from 52.7 in March, but anything above 50 is expansion. Chinese exports also rose 1.5% in April, and that was from a 7.5% decline in March. But policymakers here in the U.S., Europe, and elsewhere are really concerned that the Chinese government is pouring a ton of money into China's huge manufacturing sector, kind of flooding the global economy with cheap goods. In fact, Chia Pet Chi is over in Europe this past end of this week, meeting with a lot of European leaders. But it's not going as well as President Xi would hope. So they're really coming out with more, I think, stringent trade tariffs against China. So we'll see how all of that shakes out. Meanwhile, I'm going to switch the screen over and let's just take a look at some of the key markets here just to see what's going on. Let's start with the E-mini S&P 500 futures first. It's going to take about 10 seconds to come up on your screen as I switch screens here. But what you're going to see is the E-mini coming up off the lows that we made about the middle of April, right? I had these targeted lows. You can see these circles. These were the targets, and we hit them fairly nicely. And now we're moving up. You can see my target range here, believe it or not. Now, I had said, and I'm on record as saying that we're going to roll up and then we're going to roll back over. That's what the odds favored. Now, I believe the higher we go, the less the odds favor taking out these lows that were made here on April 19th. I do believe we're going to get a little bit of a weakness coming into the end of May, into early June, but I don't think we're going to take out these lows. So that could mean that this short little pullback here, these lows should hold before we make new all-time highs. You can see my target here. It's not completely formed. But now these are the E-mini futures would be up around 5,400. The S&P or SPX, the cash index, I've got a target of around 5,300. So that does suggest that the bullish momentum will continue, but we should expect a little bit of a dip over the next couple of weeks, 2 to 3 weeks. That's kind of what I'm seeing here. But you can see the strength of this market coming up off these lows in mid-April. Now, if we look at the equal weight versus the SPX, it's still very low. So we're not getting the broadening out of the market that I would like to see. All right. We're just not seeing it. And that's, to me, troubling. If we look at the Russell, which was the worst performer, it is still just barely in the green for the year, right? I mean, you could see the closing price, this dashed blue line here is a closing price for last year. So it's still showing a lot of weakness. But if we look at the NASDAQ 100 futures, you can see they're up off the April lows here, right? coming up strong. Still well short of the all-time highs in NASDAQ futures. And then, of course, if we look at the Dow, we'll look at the Dow futures here. Where are we? Here we go, right here. If we look at the Dow futures, it's also showing some strength this past week here. You could see where it found support at the closing price of last year. And now we're moving up to this level here. So the Dow futures are also moving up. And if I were to mark it, my system will calculate it, uses a combination of Gann and Fibonacci. It would suggest Dow is going to run up almost 41,000, right? So that's about 1,500 points to the upside from where we are now over the next 2 or 3 weeks. I do believe we're going to see some weakness. And then I think we're going to eventually climb back up and the bullish market's going to resume June, July timeframe. Okay. If we come down here and we look at VIX, as I mentioned before, the VIX closed out the week at 1255. If I put it on a weekly chart, right, just to kind of put some perspective on it, you can see here, this right here, we're down. Last time we were down around these lows was in the middle of December of last year, right? I mean, and we did hit it just briefly in March before we had that April pullback, okay? And then if I take it out again, just to show you when was the last time we were down here, we haven't been down in this area since 2020, right? Right before the COVID crash. So the VIX is just, there is not a lot of fear in the markets right now, right? And if you look at these weekly bars, it's just over the past 3 weeks, all the vol has come out of the market. All right, we were intra-week up in the 21 range, and now we're back down at 1255. If I come back, let me just put it on a daily chart, and I'll show you the front month skew. You can see the front month skew is well in the green. So that's in what we call a contango environment. So that's a normalized environment comparing VIX to the front month May futures contract. And if we look at the May over the June futures contract, this is the back month vol skew. Again, solid in the green. And then if we go out in time and compare the May to September skew, the 2-8 spread, you can see, again, solid in this green. So net, what this is telling us is that the volatility skew is normalized. The markets are not that fearful. Even though we may have a pullback, I think it'll be an opportunity to buy the dip. All right. So the pullback that I was expecting, remember, I originally said a pullback somewhere between 4 and 8%. We got almost 6%. So almost right in the middle, but I was expecting it to do a bull trap and roll back over, make another low, a lower low before we took off in late June, July. But now I've kind of revised that just a little bit. I do still expect some weakness coming into the end of May into early June, but then I think that's a good buying opportunity. And of course, if we look at Treasury market, you can see the bonds sold off on Friday, okay, but we're up off the lows, but not by much, right? And if we look at currencies and look at the US dollar, it's still near the highs for the year. All right, remember, they're going to be cutting rates more than likely. If you listen to the Bank of England and the ECB, they're both planning on cutting the rates in June, whereas in the US, the rate cut is really over 50%. You get that out in September. So if they are cutting rates and yet the rates here stay higher for longer, that'll continue to be bullish for the dollar. All right. And if I let my system try and calculate it, I don't think it's going to give me enough of see, it's barely a colored bar up here. So that would suggest it doesn't have enough data yet, but it does suggest a higher high for the dollar. Okay. And if we look at the euro, remember the euro makes up about 58% of the dollar index. And you can see we're off the lows here, but this is suggesting that the euro can go lower and the dollar can stay stronger near term. All right. So just keep that in mind from a currency perspective. And then the currency that I like a lot and have been following a lot lately is the euro. Remember down in this area here, I said you got to go long the euro. Now I think any dip here is going to be bought, and I think the euro is going to go higher longer term. All right. I've been saying you want to be long the euro for the year and then going into next year. All right, it's just the euro hadn't been this low in decades, like over 30 years. So we'll see how that normalizes itself, but that's just a little bit about what I'm seeing there. And then, of course, if we look at gold, gold had a very strong Friday. As I said with our members, we have a great way to trade this. And if you were running the trade, I was suggesting you'd be doing very well right now in gold. I think gold is going to run higher. And if I were to mark this, you can see the next target I would have for gold is right around 2,500, right? And that pushes us out in the late summer, July, August timeframe. That would be the target I would have. Now, it's not going to get there in a straight line, but I do believe gold is going to continue to move higher, okay? And there are a number of reasons for that. You've got China, Russia, India, and other countries buying gold, not hoarding, but buying gold. They've been buying a lot every month, although they've slowed down recently. But you've got the deficit crisis, you've got the funding, and the deficit in the U.S. is just creating a lot of overhang on the U.S. economy, and eventually it's going to drag the economy into the wicked bear market. Probably in the next 2 to 4 years, we're going to have 30 to 40% pullback. Right now, just ride the momentum to the upside. In the U.S. markets. And then, of course, if we come down here and we look at energy, I think oil is bottoming and it's going to be moving up. But right now, I wouldn't touch this to the downside in oil, all right? But this kind of, remember, the lower oil goes, that's not going to be a good prognostication for the overall global economy, okay? Right now, it's broken the 50 EMA. It broke to 200, did a retest. Now it's trying to break again. So if we break this, I would let oil run down and then I'd be ready to look at entering along. Right now, I'm just watching oil to see which way it wants to go. Nat gas, that was an easier trade for us. I suggested to the upside on nat gas. Once we're down in these levels, I said the best way to trade it is to go long. And you can see nat gas is going to come up here. In fact, I'm projecting nat gas to go up even higher. But now we're at that level where a little bit of a pullback, it's a buy the dip moment for nat gas, right? So that's a little bit about what I'm seeing in some of the major indexes and commodities and asset groups here in the U.S. markets. Members, I will see you this Sunday evening at 7 p.m. for our weekly market watch. If you're not a member, I highly encourage you to come in and check us out. We're pretty much right on track with where the market is as far as calling market action. All right, everybody, have a great weekend. Members, I'll see you Sunday evening at 7 p.m. for our weekly market watch. Ciao, everybody.